if you're accessing primarily your pension income via drawdown, then you will be very concerned about what the stock market is going to do next.
Yeah.
And this is particularly important in the early years of your retirement, because data's shown that a stock market crash in the first couple of years after you start working can be much more damaging than a stock market crash, say 20 years after you retire,
Yes.
even if you get the same average return over that time.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm very pleased to welcome back to the pod today Fidelity's Marianna Hunt to talk about retiring in 2026. Specifically, we're going to be talking today whether this year will be a good one in which to retire. What do current market rates and forecasts tell us about the likely fortunes of those quitting work in 2026? Before all of that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Marianna, welcome along.
I'm well, thanks. How are you, Ed?
Very well, very well. First of all, tell us why there can, in fact, be good and bad years to retire. In other words, why are more retirees reliant on what the markets are doing for the income they need in retirement?
So while you're working, the major factor that impacts your income is the jobs market, i.e. what salary you can command. However, once you're retired, that's no longer the case. And suddenly your income is dependent on a whole swirl of different factors, including what kind of pension you have and how you choose to access that pension money. So whether that's via an annuity or via drawdown. And recently, we've been seeing more and more people choosing to access their pensions via drawdown, which means they're very much at the whim of whatever the stock market is choosing to do at the time they retire. And I'm sure we'll cover later exactly why it really matters in those early years. But basically, this means that a lot of these factors are impacted by timing. And that's why there can be a good time to retire and a bad time to retire. And the other really key timing factor when it comes to retirement is what is inflation doing when you retire? Because while you're working, hopefully you should be relatively cushioned from the impact of inflation, because ideally your salary will be going up over time to account for inflation. However, once you're retired, it's on you to make sure your retirement income can keep pace with inflation, and periods of very high inflation make that really hard and can have a serious impact on how long your money lasts. So the nightmare scenario basically for a retiree is to stop working at a time when stock markets dip and inflation is very high. That's what you really want to avoid.
Well, we're going to get into all of those different factors to see what we can tell is the likely scenarios at the moment. And this risk that people face, that compares to what many people in the past would have faced when they retired, which is a quite certain level of income because they had a different kind of pension, a defined benefit kind of pension that was probably index linked with inflation. So basically a lot of these worries didn't apply in the past. But as you say, nowadays there is more of a timing risk. And it's hard, isn't it? Because people only ever have a limited amount of control about when they actually retire. Yes, they can probably flex that a bit, maybe 6 months here or there. But the truth is, I guess, that people are going to set a retirement date and they're not going to want to delay too long if they have their heart set on retiring.
No, you're absolutely right. And we've talked about the financial factors that make it a good or a bad time to retire. But for most people, this will be a really personal decision. You know, maybe they've commuted 4 hours a day for decades and just can't take another day of it. Or maybe they've got some health problems that mean they really want to stop working and make the most of the time they do have. And there's the kind of the sad truth that for a lot of people in their late 50s, early 60s, they feel like there aren't the job opportunities available to them, even if they wanted to continue working.
Indeed. Okay, well, let's get into some of the numbers. You've recently looked at all of this, all these different factors that can influence retirement income. Let's start with what shape pension pots are actually likely to be in. That's obviously a very important factor in all this. How do they sit as we move into 2026?
Okay, so here happily we can start on a bit of a positive. Stock markets on the whole have done quite well in recent years, which hopefully means that retirees will be sitting on larger pensions than they were a couple of years ago. So we crunched the numbers and looked at an example scenario: a 300k pension, invested 60% in global equities, 40% in bonds, and calculated that it would have grown to around £444,000 by the end of last year. So that's 5 years ago to end of last year. And that's not even factoring in any additional contributions, which if you were still working, you were probably still contributing.
Yeah.
So hopefully a lot of retirees are sitting on, reasonable pension pots. However, as we know, investment returns are never guaranteed, and future stock market wobbles could absolutely still derail people's plans.
Yeah. And a lot of that is going to depend on their asset mix in those years leading up to retirement, because we know that lots of people will de-risk their pension investments, whether they actually know it or not. Some of it's automatic. So away from the stock market, more bonds, and actually quite a lot of cash as well. Nowadays, there should be mechanisms to ensure that you've sort of decided what you're going to do with the money.
Yeah.
So that if you do intend to live from a pot of investments, you do still have a good slug in the stock market. But if that is you and you've got those stock market investments, it has been quite good, as you say. Now, for a lot of people, when they get to the point of retirement, the way they get their income, all or part of their income, will be via an annuity. Not as popular as they once were, but still a very, very useful and appropriate way for people to get their income. Is it a good time to be buying an annuity?
So exactly as you've said, annuities haven't been super popular for much of the past decade because the rates on offer haven't been great. However, that has been changing, and we've seen much more attractive annuity rates on offer in the past couple of years. So we looked at an example scenario of a 66-year-old and found that at the end of the last year, they might be able to get an annuity paying them between 7 and 8%, and compare that with 5 years ago, where they might have only got between 4 and 5%, which for this scenario, it worked out to about a £10,000 difference per year to their pension income. So that's significantly better than it was. And that's because of the link between annuity rates and the interest on long-term government debt, so gilt yields. And gilt yields can be impacted by interest rates. So when interest rates rose in 2022, 2023, we suddenly saw this big spike in the income that annuities were paying out. So they looked much more attractive. I should just caveat that with saying that interest rates are now coming down, and market consensus is they're going to fall further to potentially around 3.25% by the end of this year. That's what the market's expecting. So that means that annuity rates could well come down. So if you're thinking about buying an annuity and when you might do that, that's probably something to factor in.
Yeah, I guess it's always the way that a decision of whether to buy an annuity probably depends not just on the rate, but your other factors, your other circumstances, how much guaranteed income you want, because that's what an annuity gives you. Those rates there, 7-ish%, that'll probably be for a level annuity, won't it? I mean, if you want that to rise with inflation, that headline rate comes down a bit, but still very, very healthy right now on annuities. If you lock it in, that's great. You've got that forever. But something you can't lock in forever is interest on cash savings. Yeah. That's another part of people's financial mix as well. So what about cash interest? What can retirees expect in 2026 and further out?
So again, cash returns on cash are very closely linked to interest rates. And for retirees, the return you get on your cash is really important because they're probably sitting on much larger cash reserves than working people. So the expert guidance when you're working is to have between 3 and 6 months worth of cash as your emergency fund. And you might hold more if you're saving for a short-term goal. But for retirees, the guidance is that you should be holding anywhere between 1 year and 5 years worth of your spending readily available as cash. So you really don't want that sitting in a low paying account that doesn't even beat inflation.
Yeah. And so that higher proportion of your overall mix in cash, it's to do with the risks you face in the stock market, isn't it? It's basically better to get your income from a nice pot of stable cash savings, replenish that with investments, and then you can leave your investments alone, essentially. That's basically the logic there. Okay, so potentially lower interest rates on cash. But the flip side, for some people, might be lower rates on borrowing as well, including mortgages. So what is there to say there?
Exactly. So if you've got savings on one side of the interest rate coin, then you've got mortgages and loans on the other. So hopefully lower mortgage rates. Yes, it might mean lower savings rates. Lower interest rates might mean lower savings rates, but it also hopefully means better mortgage deals on offer, which is good for retirees who are still paying off their mortgage. However, it probably won't impact most people because generally retirees are trying to pay off that mortgage debt before they stop working. So they're not having to make their mortgage repayments out of their pension income. So helpful, but not that helpful.
Yeah. Dare I say it? This isn't looking too bad so far. I mean, lots of these factors by sort of like historical norms look quite good at the moment, I would say. However, there are some things that we haven't mentioned so far that are far less certain and are very, very important. One of them, of course, is the returns in the future from markets. That's obviously important if you've got a bulk of your savings invested in markets. What can we say here? We don't know the future, obviously, but what can we say?
So yes, if you're accessing primarily your pension income via drawdown, then you will be very concerned about what the stock market is going to do next.
Yeah.
And this is particularly important in the early years of your retirement because data's shown that a stock market crash in the first couple of years after you start working can be much more damaging than a stock market crash, say 20 years after you retire,
yes,
even if you get the same average return over that time because of something called sequencing risk. So this is the idea that having to sell your assets at a loss is much more damaging early on in retirement because you're having to sell more assets to get the income that you need, and you therefore have fewer assets to last you for the rest of your life and to benefit from any subsequent rebound in stock markets. So retirees are going to be very concerned about what stock markets are going to do next.
Yes, indeed.
And so
the question is, what will they do next? Like I said, we don't know for sure.
Yeah.
Markets are at quite a high level at the moment. So should there be some nerves around this?
Well, it's exactly the right question to be asking. And a lot of investors are asking this question, and there is nervousness because, as we've said, we've had this period of quite positive returns, but now some company valuations are starting to look very high and potentially a bit stretched. So there are questions of, are we in a bubble? Are these valuations sustainable? Now, my personal opinion is that it's a fool's game trying to guess what the stock market is going to do next because experts have been trying to do it for decades and most of them got it wrong. So potentially the much better option is simply to have a really robust plan of what you would do in a stock market crash and how you'd weather that storm.
Yeah, I mean, there's loads to say on this. One thing I would say, we conducted some work last year. It is last year now, that looked at 10 years of people withdrawing pension income from April 2015 till 25. And those people actually suffered the nightmare scenario that you've laid out. They lost in that first year after they retired, they lost something like 20%, especially if they had like a big exposure to shares. But those values recovered even with that income being taken, which is, as you say, a very dangerous moment if you're withdrawing money. And they've gone on to be basically absolutely fine because markets have recovered, wiped out those losses in that first year. But no doubt it would have been very worrying. Yep. But it's a good reminder to stick the course when it comes to the stock market. You're going for that long-term averaged out return, and you do have to kind of see through, if you can, the volatility that you're going to get. You're bound to get it. In terms of the situation right now, yes, some major parts of the stock market are very stretched, big tech companies in the US specifically, and they've driven a lot of returns for a lot of people for a long time. And who knows? They could correct. We know that. That's a sort of constant risk. But other markets don't look as bad. You know, the UK, other places in the world look far more fair value. And also you can do, as we've said, you can have a pot of cash on hand. So you don't actually have to immediately feel the hit of losses in the stock market in terms of your income. You're taking that from a pot of cash. So you can leave your investments alone. One final thing, I've been thinking about this a lot, is I wanted to mention dividend investing. which gives you a bit of ballast to your investment return, which is helpful. If you look for dividends that are rising, there's a bit of an inflation hedge as well, and it tends to give you a bit of protection in these sort of more uncertain times. So, long story short, yeah, there's risks. There's always risks, but you can actually organise things in a way that kind of mitigates some of that risk.
Absolutely. And there's also the option that some people might take of considering working for a bit longer if there is a significant market crash in the early years of retirement. Potentially a combination of a part-time job and the state pension could mean that you have enough income to live off and you can just leave your stock market investments rather than drawing down on them when they're at a loss.
Yeah, and that's a really good point. We talk a lot here on the podcast about phased retirement and the fact that, look, for a lot of people, it will be a cliff edge and they'll just be like, right, working one on a Friday and then I'm on the golf course or whatever from the Monday, and that's just life has changed. But for a lot of other people, it will be done in stages and they'll be working fewer hours, less stressfully, but they'll continue to earn some money. And yeah, that's going to be useful if you're in a moment when stock markets are uncertain. Another big unknown for all this is inflation. You've mentioned it before. It can be an income killer, can't it? Lots of retirees will have felt this in the past few years. Where are we right now with inflation?
Yeah, it's so funny because I think people can spend sleepless nights worrying about a stock market crash. And actually, it's just inflation that's slightly higher that could be the real killer to their retirement savings. So we actually did some number crunching last year when inflation was at 3.6%. It's now 3.5%, and calculated that inflation of 3.6% rather than the Bank of England's target of 2% could mean that a typical person's pension pot runs out 11 years sooner, which is a massive difference.
Yeah.
Now, here the news isn't incredibly positive because the OBR is expecting that inflation will remain above the Bank of England's target this year. So it's expecting inflation of around 2.5% this year, and that it won't get down to 2% until 2027. However, the positive is that it looks like price rises are slowing down and we are slowly getting on top of inflation. So things could definitely be worse.
Yeah, they could. And as you say, it's just impossible to know. I mean, if you think about the drivers for inflation in recent years, it was a war. I mean, very hard to predict for certain what's going to happen in those kind of situations. There is a worry that the inflation will settle at a higher level than it's been in the past. So the 2% target that the Bank of England talks about, they'll sort of flit above and below that target. But there is a sort of a sense that maybe things will settle a little higher than that. And that's definitely something to watch out for. Finally, for our discussion here, the state pension. We've left it to last, but actually it's very, very important, isn't it? Because you might not think it, especially people watching this podcast who have saved and have got lots of money saved for retirement, for example. The state pension is still likely to make up a very significant part of their income, maybe even most of it, basically. So what's going to happen with the state pension in 2026?
So happily, this one is another positive.
Yes.
We've actually seen one of the biggest multi-year increases in the state pension recently because we had that period of very high inflation where the state pension went up with inflation, then wage growth caught up with it. So we had 2 very high years of state pension increases. And that means that the state pension has been beating inflation and looks like it will continue to do so. So that's really positive.
It is. And of course, locked to do that again and again and again because of the triple lock that people will know. Don't need to go into it, but that's good for the state pension. Marianna, look, we've covered absolutely loads there. I guess the overall conclusion is it actually isn't a bad year to be tried, right? I mean, like we say, maybe people change their plans or not, but there's definitely been worse years given what's going on in markets.
Let's hope the stock market gods smile down on us.
Exactly. Yeah. So if you are retiring, all the best of luck. Right. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel, give us a like, and leave a comment in the section below. It does help people find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Marianna, thanks an awful lot for joining me.